question number 4. So if you are here, please confirm. If you have the question with you, just confirm. Just confirm whether you have the question. Yes, confirmed by Elizabeth, confirmed by Patrice. Okay, so what are we told? Account, opening the books of accounts. Of the books of account, books of what? Of accounts of the old or the selling company. Of the old or the selling what? Company. Now, after doing that, like this particular question here, you have now to proceed and you make the journal entries. The journal entries to do what? To open the books of account, to open the books of accounts of the new company. The new what? A company. And then finally, you prepare the statement of financial position equally for the new what? A company. Essentially, these are the steps you should follow. But we said in an examination setup, I will not advise you to compute this, because if you can remember the question we did yesterday, I think you can be able to recall how computation of the purchase consideration was demanding, and also it is time consuming. So therefore, if you happen to come across this question in an examination setup, avoid computing this. Even without having computed that, you'll be able to get good marks, basically over 15 marks, without having computed that purchase consideration. So what we need to do basically, we will go straight to crossing of the books of account of the selling company, basically by preparing the relevant ledger accounts. So those are the ledger accounts we require to prepare in Roman 1, the realization, ordinary shareholders sundry members account, the preference shareholders sundry members account, to cross off the books of account of the owned or the selling company. Then from there, we're going to make the journal entries for the journal entries to open the books of account of the new company. And finally, we prepare the statement of financial position of the new company. We'll be able to see that by using that particular approach, that question, you should be able to do it within 30 minutes. You have more than 15 marks, you move to the other question. So therefore, you move to this one to cross off the books of account of the old company. But before you do that, it is important for you to recall what you're told in paragraph 1. The company which is to be structured is 𝐎𝐶𝐒. This is a company which has been making losses, and this is the company which is to be liquidated. Its business operation, assets, and liabilities taken over by a new company, which you're told will be known as 𝐎𝐍𝐋 Limited. 𝐎𝐍𝐋 Limited. So therefore, this is the selling. In other terms, this is the old company, whereas this is the new. In other terms, we refer to this as what? As the purchasing company. As the purchasing good company. So the first thing we need to do basically is to cross off the books of account of 𝐻𝐶𝐒, and we do that by preparing the ledger account we are required to prepare as per Roman 1 of that question. So we move to, or basically we go straight to Roman 1 of the question, and we are required to prepare the relevant ledger account to cross off the books of account of 𝐻𝐶𝐒. So part A of the question, ledger account to do what? To cross off books of accounts of who? Of 𝐻𝐶𝐒 Limited. So which ledger account do we prepare? The ones which are listed there. The realization account, we're going to start with the realization account. The realization account. Then from there, we will prepare the other ledger account, which is called the ordinary shareholders sundry members account. Ordinary shareholders sundry members account. So we don't have so many entries which we record here. And then from there, Roman 3, we are required to prepare the preference. The preference are shareholders sundry members account. The preference shareholders sundry members account. Yes. So basically, we said what we just need to recall is what we record in each of these accounts. And actually, we said when crossing off the books of account of the old or the selling company, what we do, we go back to the balance sheet, to the statement of financial position of this company, And basically, you have to cross off all those particular accounts which had balances and whose balances are shown in the balance sheet or in the statement of financial position. Can we go back to the statement of financial position of this company? The information which we have, or actually the statement of financial position. Now, what we said, we start by crossing off the asset account. You can see under the non-current asset, we have two assets. We have property, plant and equipment, goodwill, and then current asset, we have inventory, trade receivables. Now, we say if you go to the additional information, you'll be able to see somewhere being told, or basically you'll be able to see a note whereby you are told, you are given information about the assets which were transferred to the new company, and those may be assets which were written off. Usually, or in our case, that is in note number 6. Even without reading all the notes, I can see that in note number 6. Can we see, go to note number 6? We are told the tangible assets were transferred to the new company at the following fair values. Which assets were transferred? They include property, plant and equipment, inventory, trade receivables, and then you're told goodwill was considered valueless and it was written off. So therefore, we go back to the statement of financial position. We have 4 assets, 2 non-current assets and 2 current assets. We know the PPE, inventory and receivables were transferred to the new company, goodwill was written off. Now, what we said, those particular assets which were taken over or transferred to the new company, we debit them here at the book values. The book values are the values we have in the statement of financial position, but it's also important for us to indicate that our values will be in thousands of shillings. So the assets which were transferred to the new company include the PPE. What is the book value for that? Remember, we said we use the book value or the carrying amount. The book value or the carrying amount are the values we have in the statement of financial position. Not the values we have in note number 7. The values we have in note number 7, we are going to use them when opening the books of account of the new company. So that's very important. So the book value for this is 59,500. 59,500. Then below that we have goodwill. Goodwill is an asset which has been written off. We say those assets which are not transferred to the new company and they are written off. Basically, those assets are supposed to be debited in this account, not the realization, but the ordinary shareholders and the members account. Goodwill was written off as per note number 7. The value for that is 9,000. So then from there we go to where we have current assets. The 2 current assets as per note number 6 were transferred to the new company. We debit them here at the book value. The book value are the values we have in the statement of financial position, 18,500, and then this one, the trade receivables. The trade receivables is what? Is 14,500. So basically, we are done with the asset. We are done with the asset. So we say don't skip anything, because for the asset can either be transferred to the new company or written off. Those assets which are transferred to the new company, you debit them there at the book value. Those assets which are written off, debit them there at the book value. Then from there we go to the equity. So for the equity, we have the ordinary share capital. Ordinary share capital. Just a minute. Yes, so we continue. So basically, I've said we are done with the assets. We go to where we have equity. So equity, we start with the first item, which is ordinary share capital. Ordinary share capital, we say is crossed off to this account and actually should be credited. Ordinary share capital. So ordinary share capital, basically it should be credited here, and that is basically an amount of 60,000. So then below that we have 9% cumulative preference share capital. Preference share capital will be crossed off to that account and equally should be credited in this account. It should be credited in this account. It should be credited in this account. The 9% cumulative preference share capital, and that is an amount of how much? Is an amount of 30,000. Then below that we have share premium. We say any form of any reserve should be crossed off to this account. Share premium and any other reserve, that one should be crossed off to this account. It should be credited here. Basically we have 30. And then below that, we have accumulated losses. Accumulated losses is still a reserve, but that one, because it's a negative, it should be recorded on this side. Should be recorded on what? On that side. on that side, the accumulated losses. The accumulated losses. How much are the accumulated losses? 27,400. 27,400, like such. So I hope you can see we are done with the items of equity. Then for the items of liabilities, we have the bank loan and the current liabilities. So we must be given some information in relation to this. In most of the cases, we say liabilities, unless otherwise they are transferred to the new company. We must be given some information in relation to that. Like if you go to note number 7 in our question here, we are told the liabilities are non-current and current. The liabilities were taken over by the new company at their book value. So all the liabilities, the non-current and current, were taken over by the new company. So the liabilities which are transferred to the new company, we say they are credited here. They are credited here. We start with the bank loan. We start with the bank loan. So the bank loan is basically 22,500. And then we have the trade payables. The trade payables, which is basically 59. Then we have the tax payable. The tax payable, which is basically 3,000. We have the bank overdraft. The bank overdraft, which is 45. Now you can see what you have done. First of all, we have closed off all the accounts which had balances as per the statement of financial position which is given there. Now, there are two other items I think we said we must always remember to account for here, because the other item which we should compute or basically credit here is the purchase consideration. But I've said don't bother yourself computing that. Ignore that purchase consideration, because if you happen to compute that, you'll consume a lot of time doing this question. It's not a must you have to compute that. You'll be able to get good marks even without computing this. Now, the two items you should always remember to account for is, in all questions for external reconstruction, you'll be told this company which is being restructured had not paid preference dividend for a number of years. So what you need to do, you need to compute the preference dividend in arrears. So this one must be given somewhere in the additional information. You just need to go through those particular additional information. There must be somewhere you're told you're given that information. Where do we have that? I can see it in note number 4. I can see that in note number 4. We are told the preference dividend in Tanga were 3 years in arrears, and the preference shareholders, in fact, we can just ignore that. We just need to know the preference dividends were in arrears for how many years. We are told the preference dividends were 3 years in arrears. That is our interest. The other information is basically for computing the purchase consideration, which you have said we need to ignore. So the preference dividends in arrears, we are told they were 3 years in arrears. How do we compute the preference dividends which were payable by Tanga? We are going to use this information about the preference share capital. The company had issued 9% preference shares, meaning the preference dividend to be paid each year will be 9% of this. That will give us the preference dividend per annum times what? Times 3 years, because they were in arrears for 3 years. Yes, that basically gives us the preference dividend in arrears for how many years? For 3 years. So let's work out this. So we have 9% times 30,000 times 3. And basically we are getting what? We are getting 81. So how do we account for this preference dividend in arrears? The preference dividend in arrears, we say they are debited here in that account, and then we credit them in this account. The preference dividend in what? In arrears. 81. The other item we should also remember to account for is to debit the liquidation cost here. The liquidation cost which was incurred in liquidating this company and paid by the old company should be credited here. You should also be given that in the additional information. Let's go to the additional information number 5. I can see it somewhere in note number 5. And you're told the liquidation expenses of Tanga amounted to 8 million and was basically settled by Elewa. So there was a liquidation cost of 8 million. Now these are the two additional items you should always to remember to account for, and which are not given in the statement of financial position. Now, once we are done with that, basically in our case, we are done with the part A. We are done with part A. Basically, that's what you should do in relation to part A. And now, if that question you leave it at that point, you'll be able to see that you can only maybe lose 1 mark or maybe 2, even if we have not computed the purchase consideration. Because, for example, in terms of how this account is marked, this is now the items which will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9. How many marks are allocated here? The marks allocated here are 8. So the minimum marks you can be allocated. In fact, this is how this account is marked. Any marks allocated here for any 8 at half. Any 8 at half. Any 8 at half. Any 8 ticks. Each tick you get what? Half. It basically means that you need to get 8 ticks here. How many ticks do we have? We already have more than that. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we already have 4 marks there. 4 marks there. Now this one is basically marked like this. Any 4, because the marks are located here at 4, any 4 at 1. Because I think just 2 items which are missing here, the purchase consideration and the realization gain on loss. So 1, 2, 3, 4. You can also see here, we already have 4 marks. We already have 4 marks. And this account also is marked any 2 at 1. So I can be able to share with you the marking scheme. You can be able to see. So in that case, you can see we already have 2 entries. How many marks are located there? 2 marks. You can see within 10 minutes, you should be having those 10 marks with you. You should be having those what? 10 marks with you. Now, once we are done with that, we need to move to the other part of the question, and that is part B. Part B. So what are we required to do in part B? In part B, basically we are required to make the journal entries to do what? To open books of accounts. Books of accounts of who? Of the new company. Remember, the new company is called what? 𝐻𝐿𝐻 Limited. So we are required to make the journal entries to open the books of account of the new company. Remember, you said that if you are required to make the journal entries, now Odiek is asking about. Now remember the other question we did yesterday. Now the double entry for this liquidation cost is debited here, and then the other entry should be in the purchasing company account. Check the other question we did, but you can see we are not required to prepare the purchasing company account. Are we required to prepare that, the purchasing company account? No. So that's why we are not completing that double entry. Sasa? Yes, we are not completing that double entry. But in case it was required, then you have to prepare that and then you credit that amount in that account. Sasa? Yes. So let's make the journal entries. Now, when making the journal entries here, you make journal entries basically for a number of items, which are obvious. So number 1, account for the assets which are taken over. Number 1, make a journal entry for the assets which are taken over at the fair value. Number 2, account for the liabilities. For the liabilities taken over, liabilities are taken over at the book value. Number 3, account for the liquidation cost which was paid. Now, by basically accounting for these 3 items, you'll be able to score also all the marks here. So account for those 3 items: asset taken over, liabilities taken over, and the liquidation costs which were paid. Don't even bother going through the additional information there, because you can see we know the assets which were taken over, we know the liabilities which were taken over, we know the liquidation cost which was paid. But maybe you can also peruse through, you see whether there is anything you can account for. For example, I think in note number 8, we can see whether we can make any journal entries here. But basically, let's make a journal entry for those 3 items. 1, we will account for the assets taken over. So we can say assets, instead of giving an addition, we can say what we are accounting for here: an asset taken over, the asset taken over at the fair value. So how do we account for these assets which are taken over? Remember, we are doing a journal entry. We are passing a journal entry. Automatically, once the new company takes over some asset, those assets should be debited in the respective asset account. And then credited in the account called business purchase account at the fair value. So the assets which were taken over by our new company, we have those assets in note number 6. So the assets which were taken over, number 1 is the PP. So we are going to debit, that one will be debited in the PP account. At an amount of 55. Remember, values here in thousands of shillings. So we debit PP. Then we the other asset which was taken over is basically inventory. That we debited in the inventory at an amount of 2,200. So then from there we have the other asset which is basically trade receivables, which is an amount of 14,500. Yes, basically I think those are the 3 assets from what we have here which were taken over. But there is something also you must be able to recall. If you can remember the question which we did yesterday, we said that once all these liquidation costs which is incurred by this company, we say it is always paid by the new company. Now, once the new company pay for that liquidation cost, in some questions, not all, you can be told that the new company decided to account for that as a preliminary expense. So if it decided to account for that as a preliminary expense, it basically means that this company capitalized that particular cost, and therefore it recognized that as an asset. And what we say, therefore, you need to recognize that here as one of the assets which was inherited, one of the assets which was acquired from the old company. So what we need to do is to check whether this particular this liquidation cost, was it recognized as a preliminary expense. So let's go to the information which we have in note number 6. We are told note number 5. We are told the liquidation expense of Tanga amounted to 8 million and were settled by Erewa. Is there anywhere we are told that this particular cost was to be capitalized or it was to be treated as preliminary expense? Are we given that information? Yes or no? Are we given that information? No. But if we were given that information, then we include it here as one of the assets which was inherited from the old asset. That's yes. So then with the total amount, we credit the business purchase account. We credit the business purchase account. So with the total value of the assets which were taken over. So we have 55 plus 2200 plus 14 plus 14,500. So this will give us 89,700. 89,700. Remember, we have already explained there above. We have already explained here what we have accounted for. What we have accounted for are the assets which were taken over. Number 2, we account for the liabilities which were taken over. Liabilities taken over. Liabilities taken over. Remember, the liabilities we said are always taken over at the book value, because we say liabilities are not revalued. We say you cannot revalue a liability. For example, you can see that this company had a bank loan. There is no way you can revalue a liability. There is no way you can do what revalue a liability. So how do we account for this? How do we account for these liabilities which were taken over? So what we do is that we debit the business purchase account, we credit the specific liability account. So in our case, from the realization account which we have here, we know that we have how many liabilities were taken over, 4 of them. These liabilities. So we will debit the business purchase account. We will debit the business purchase account. And then we credit the liabilities account. So we have the bank loan. We have the trade payables. We have the trade payables. We have the tax payables, and then we have the bank overdraft. The bank what? The bank overdraft. So let's first of all we credit those accounts. So the bank loan was the bank loan is 22,500. The trade payable is 59, and then the tax payable is 3,000. The bank overdraft is what? Is 55, is 45. That is 45. Then we need to get the total and we debit it in the business purchase. So 22,500 plus 59 plus 3,000 plus 45. And basically that will give us 35. 900. So what have we accounted for here? We have accounted for the liabilities which were taken over. Now then from there, we also have this, and this is something you'll come across in all questions, the liquidation cost, which was paid by the new company. So make a journal entry for that. Liquidation cost, which was paid. The liquidation cost which was paid. A liquidation cost which was paid. Now, this liquidation cost, the liquidation cost which was paid, this one, number 1, should be credited in the bank. Should be credited in the bank. And then from there, we debit an account called what? The selling company account. So the selling company, remember, is the old company. That should be the journal entry. So we debit the selling company. Remember, the selling company is Tanga Limited. So account. How much is the liquidation cost? The liquidation cost is 8,000. 8,000, and then we credit the account which is called what? The account, or basically with credit bank. Remember, this amount was paid with credit bank. We credit what? Bank. We credit bank. Now, once you make those journal entries, I think you can just leave it at that point. Just leave it at that point. How many marks are allocated there? The marks are allocated there are 6. So basically, this what will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So the minimum marks you can be given per entry can be half. So meaning that you're required, for example, for you to get 6 marks, you need 12 ticks, each half, and you get what? 6 marks. How many ticks do we have here? We have 11. So you'll get 5.5 to the nearest whole number, that will be 6. To the nearest whole number, that will be what? That would be 6. It basically means that by doing that, you already have all the marks. You already have the 6. Now, then from there, we proceed and basically prepare what is required in Part C. Part C. Can you see how simple this question is if you use that particular approach? Can you see how simple this question is? Basically, to get those particular marks, very, very simple. Very, very simple. So you can see already we have 10 marks here. We have 6. So we already have how many marks? We already have 16 marks. So then from there, we basically prepare what is required in the last part. In the last part, that is the statement of financial position. Opening statement of financial position. Position is at 1st of July. 1st of July 2022. 1st of July 2022. Now, equally here, I think we have so many marks which are free because, like, we know which assets were taken over. So all those are basically free entries. Here, we just need to post them here. So we just need to have a single column pair. We start by recording the non-current assets. So the non-current assets, we record the assets which were taken over from the old company, from the selling company. And remember, you see that we record those particular assets here in the books of accounts of the new company at the fair values. So these are the assets which were taken over here. So we start with the PPE, property, plant and equipment. This was taken over at a value of 55. Maybe the other item you can also include here is the preliminary expense. If the liquidation cost, which was paid by the new company, was capitalized, or in other terms, it was treated as a preliminary expense, also included there. But in our case, you can see it was not treated as preliminary expense. Then from there, we move, and basically we record the current assets. Now, for the current asset, I think we have these two. Inventory. Inventory basically is this value 20,200. What about receivables? And receivables, basically that one will also not change. 14,500. Automatically here we may have other assets like the bank balance and so on, but no need of even computing the bank balances. No need of even computing the bank balances. Then from there we move and basically record record equity. Now for equity, I think we can be able to get this because in note number 1, can we go to note number 1? We are told that the ordinary share capital of 𝐻𝐶 Limited, which is the new company, is shillings 100 million. That is the ordinary share capital, comprising of 10 million shares of shillings 10 each. So then, basically what we know is that some of the shares were issued by this company to pay the purchase consideration. There is some information which we have in note number 8. Note number 8. In note number 8, we are told 𝐻𝐶 Limited, which is basically the new company, issued for cash and at par all the remaining ordinary shares not issued as part of the purchase consideration. The proceeds from the issue were used to pay the bank loan. So the bank loan will not appear here because you can see it was paid. But in this case, can we be able to compute the ordinary share capital of the new company? Yes. The ordinary share capital of this company will be equivalent to the registered, because we are told in note number 8, those shares which were not issued by the company to pay the purchase consideration, all of them were issued for cash and at par. So basically what that means is that the share capital of this company will be equivalent to the registered share capital as per note number 1. The registered share capital of this company as per note number 1 is 100 million. Is 100 what? Million. That will be the share capital. Then from there, non-current liabilities. Non-current liabilities. So this company, I think the obvious non-current liability we can have is the bank loan, but basically we are told this bank loan was paid. It will not appear here. It will not appear here. Then from there, we record the current liabilities. Now for the current liabilities, we have these current liabilities which were taken over, three of them. So automatically this bank overdraft was paid because there was money which was received. So that one was paid, the bank loan was paid. Maybe you can just check whether we have any other information about the two other liabilities, the trade payables, the tax payable. And I think there is no information that we are given about the payment of these two liabilities. They will appear here. So we have trade payables. Trade payables is basically trade payables is basically 59, and then we have tax payable. Tax payable, we have what? We have 3,000. We have 3,000. So now that question, that is part C, equally divided at that point. Equally divided at that point. Divided at that point. So how many entries do we have here? 1, 2, 3, 4, 5, 6. Even if, for example, you're given half, you can see you'll be having how many marks? You'll be having 6. You'll be having 3. You'll be having 3. But I don't think they can give half, because how many items may be missing here? This one, bank, maybe goodwill. Those should be 2 items. Those should be 2 items. 2 items. Yes, I don't think they can mark it at half. Maybe it was marked at 1. So I've said for the bank for this ordinary share capital, see what you're given in note number 8. In note number 8. In note number 8. In note number 8 and also note number 1. So in note number 1, you're given the ordinary share capital 100 million. And then you're told in note number 8 that there are some shares which were issued to pay the purchase consideration. And therefore, the shares which were not issued to pay the purchase consideration were issued for cash. By the end of the day, our company had issued all the shares. Our company had issued all the 10 million shares, each share having a par value of 10. That's basically why we are arriving at the share capital of this company as 100 what? As 100 million. As 100 what? Million. Sasa? Yes, as 100 million. As 100 what? A million. So basically, that's how we should approach that particular question. How we should approach that particular question here. And basically, by doing that, you should be able to get over 15 marks. Over 15 what? Marks. So using that particular approach, you should not take even more than 40 minutes to do that question. And then I'm saying that you should be able to get more than 15 marks. So therefore, if you happen to come across this question, don't bother yourself computing the purchase consideration. Just use that particular approach. Use that particular word approach there. Now, we have another question here for merger. A question which was examined in 2018. A question for merger. A question for merger. And this is a very, very common area. These are very, very common areas. So what you'll do, you'll also attempt this question on your own using that particular approach. May 2021, there is a similar question to this. May 2021, you do it using this particular approach. May 2021, question number 2. Do that question using the same approach. Actually, if you go to that question, I think you'll be able to see that the requirements are almost the same. We're required to prepare those accounts to cross off the books of account of SORA, and then the statement of financial position. So this question does not require the preparation of what? Of the journal entries, basically to open the books of account of the new company. But let's go to that question for merger. There was a question there for merger. Yes, November 2018, question 2. November 2018, question 2. November 2018, question 2. November 2018, question number 2. November 2018. So you are there, please confirm. November 2018, question number 2. Yes, can we take a small breather of 5 minutes before we look on this one? Do we take a small breather? Yes, let's just take a small breather. We come back at 9:05. We continue. 9:05, we come back. We continue. Yes, so let's continue. I hope you are back. Are you back? So that we can continue. So please confirm whether you are back. Confirm whether you are back. Confirm whether you are back. Okay. So I want us to go to this question for November 2018, question number 2. This basically is a question for merger. And let's go through the question. We see what we are told. The question reads, B Limited and H Limited are private liability companies operating in service sector. They have been reporting successive trading losses for several years, principally due to severe competition, which has put downward pressure on the revenue. So the directors of the two entities, who are also the main shareholders, have unanimously agreed to wind up the company's respective business and amalgamate them into a new company to be named as S Limited with effect from 1st October 2018. So we are given the statement of financial position of the two companies as at 30th of September 2018. That is B Limited and H. What do we have there? We have the non-current assets, which comprises of the PPE. We have the intangible assets, which are copyright. We have the current asset and the total asset. We have equity, which comprises of ordinary share capital, 7.5% cumulative preference share premium, and then we have losses. Then we have non-current liabilities, which comprises of 10% debentures, and then we have the current liabilities. Current liabilities comprises of trade payables and the bank overdraft. We have additional information about all the to note number 10. So then what are we required to do here? We are required to prepare the following ledger account in columnar format. I'll be able to explain what you mean by that. To cross off the books of account of B Limited and H, realization account, preference shareholders salary members account, the ordinary shareholders salary members account. Part B, we are required to make the general entries in the books of account of S to record the transfer of assets and liabilities. We are told to ignore narrations. So then part C, we are required to prepare the opening statement of financial position of the new company. Now, this one is basically a question for merger, because basically what you are told is that we have these two companies. As per the information we have in paragraph 1, we have these two companies, B Limited and H Limited. These companies have been making losses for a number of years, and therefore we are told that it has been decided by the directors, who are also the shareholders, to wind up these two companies and their respective business to be taken over by a new company to be known as what? To be known as S. So therefore we have B Limited. These two companies are merging, B Limited and also H Limited. These two companies are merging. Remember, in case of a merger, basically what happens is that the identity of the old companies disappear, and then a new company will be formed, which is known as what? S. So therefore, these two companies, because they are being liquidated, we refer to them as the selling, or basically the old company, the selling or old company, selling or old companies, whereas this one will be the new, or basically what? The purchasing company will be the new or the purchasing what? Company. So what we need to do basically is we cross off the books of account of these two companies, B and also H, and then from there we open the books of account of who? Of S. Now, when crossing the books of account of these two companies, B and H, we need to prepare the normal account, the realization, ordinary shareholders, the preference shareholders, and members account. But do we prepare those accounts for individual company? No. So what we do, we prepare a single realization account, but with the two columns. A column for B Limited, a column for what? For H Limited. The same case now to the other account, the preference and the ordinary shareholder salary members account. So therefore, we will go straight to part A of that question. And basically, we prepare the ledger accounts to cross off the books of account of these old companies. So part A, we are required to prepare the ledger account. The ledger account to do what? To cross to cross off books of accounts, books of account of B limited and also H limited, B limited and H what limited, B limited and H limited. So we will start by preparing the first account, the first ledger account, and that is the realization account. The realization account. Now, this realization account, I've said, we are going to prepare realization account for the two companies. That is basically B and H. So meaning that on the debit side, this is basically the debit side, we will have the details column, and then realization account for B. And it's always advisable to check how the information is given. For example, you can see we're given the statement of financial position for B, followed that with that of H. So also arrange your account like that, B and H. So the details, B and also H limited like that. So then I think our figures are also in million of shillings. We will come here and we indicate that all our figures will be in thousand of shillings. Yes. So then from there, remember this is now what you require to prepare in Roman 1 of the question. In Roman 1. So in Roman 2, we are required to prepare the ordinary shareholders, salary, members account. Also, we prepare this for the two companies, that is basically for B and also who? And H. B and H. B and H. So we have the details column, B limited and H limited. So the details are B limited and H limited, like that. Yes, and then next we have Roman 3. Roman 3, we have the preference shareholders. The preference shareholders, salary members account, salary members account. The format is the same. Details, and then we have B limited, we have H limited. On the credit side, the same columns, details, B limited and also H limited. The values are in thousand of shillings. The values are in thousand of shillings. Are in thousand of shillings. Sasa, like that. And let's assume, for example, in this question, we also require to prepare the purchasing company account. So basically, no much entries we can be able to make in that account, because majorly what we record here is the purchase consideration. But let's also prepare that account. We see what we can record with in that account without necessarily or without having computed the purchase consideration. So what do we record in this account, which is called the purchasing company account? The purchasing company in our case is S limited. Company account, and remember here purchasing company is 1, so therefore we are not preparing for B, we are not preparing for H. The purchasing company is what? Is S. Yes. Now having that, I think what we need to do is basically remove and prepare this particular account. Let's proceed and prepare these accounts. And remember, we prepare this account basically to cross off the books of account of the two old companies. So what we do, just like what you have done in the other question, we go back to the balance sheet of these two companies. The balance sheet of these two companies, B and H, we start with crossing off the asset account. So we have a number of assets there. We just need to know which assets were taken over by the new company, which assets were being written off. So that information I can see it in note number 8. So we are told that tangible assets were taken over by S at the following fair values. The assets which were taken over include PP, current assets. Now, you can see, I think in the balance sheet, we have how many assets, PPE, we have intangible asset, which is copyright, and then we have current asset. We must be given some information about intangible asset, what is happening to the intangible asset, because intangible asset is not one of the assets which was taken over. Now, that information, we have it in note 7. In note 7, you're told the copyright of B, which is basically the intangible asset, expired upon amalgamation of the old companies, and therefore was to be written off. So therefore, the copyright, which is the intangible asset, was to be written off. So therefore, starting from where we have the asset, the PPE of the two companies were transferred to the new company. So we need to debit them in this account at their book values. The book values or the carrying amounts, these are the values we have in the balance sheet. So the PP of B, 16,500, the PP of H, 12,000. So then from there we have the intangible asset. Intangible asset, this one was written off. So being an asset which was written off, we basically debited here intangible asset, and this is only for B, 84. This company didn't have intangible what asset. Then from there we have current asset, and current asset we are given the total. As per note number 8, current assets were taken over by the new company. So being assets taken over, we debit that here, current assets, which is how much? 52,500. And basically how much? 30,000. That's basically what we have there. Then we go to equity section. In the equity section, we start with the ordinary share capital. So the ordinary share capital basically will be credited in this account here. Ordinary share capital. Ordinary share capital. Ordinary share capital for the first company is basically 30,000. For the other company is what? Is 16,000.